Hey everybody, I'm Debt-Free Joel and welcome back to my channel. On today's video, we're going to be talking about inflation part 2, right? So on the first video, I'll put the link up that talks about specifically what inflation is and why you really should be concerned about it. In this video, we're going to try to figure out ways to stay ahead of inflation. Long story short, it is going to involve some sort of investing, right? Because investing has compounding returns over time that are higher than inflation. So feel free to like the video, feel free to subscribe to the channel. If you have any comments, any questions or anything like that, feel free to put them in the comment section below, and let's get started. So inflation can actually be a big problem for us, especially in the Black community, and particularly because we don't invest, right? We don't have our money making money at a faster rate than what inflation is. Now, inflation has averaged roughly about 2 to 2.5% every year. Like I described in the other video, you can look back in the 1970s and see what a cup of coffee is compared to now and see what the effect of inflation is. But the problem with inflation is that you need to figure out a way to keep your money up so that you can stay ahead of it. Now, one of the things I think is very critical for everyone is that they should have some sort of investment account, whether it be your 401k, whether it be a private account, whether it be both. But your money should be keeping ahead of inflation. In particular, the equity asset class has been one to keep up or surpass inflation over the last 150 years. So when you look at the equity asset class, think of the S&P 500, that's averaged 7% over a year. When you compare that to inflation, that's averaged 2% over a year. So technically your money is growing at a 5%, right? 7 minus 2. Now, this is pretty simple for people who are in their 30s, their 20s, their 40s, right? Because they have a long time horizon to let their money grow over time. But for folks that are not people who like risk, right? Because when you invest in equity securities, you do, consider a large amount of risk. But for people who are also close to retirement, maybe investing in equities is not the greatest idea. There are some other things you can invest in, right? Some inflation protected securities, for example, that you can invest in, but it may not compound at the same rate over time. But either way, that's the first step you need to do, is take a look at your portfolio, for example, and see that to make sure that you're keeping up with inflation. Now, for those of you who don't have an investment account, maybe consider opening one, whether it's maybe buying an ETF or a mutual fund that you just add money to every single month so that it compounds over a long period of time and keeps ahead of inflation. I think that's important for all of us to have, especially in the Black community. I think you should have your retirement account. I think you should get out of debt, but I also think you should have your separate investment account on the side that allows you to compound that money over time so that you can use it for things around. But the first step I think that you need to really consider is to make sure that your investment account, your securities that you've chosen, are there for the long term to be able to keep up with inflation and hopefully surpass it. So if you're looking for securities to add to your portfolio to try to keep ahead of inflation, you're probably thinking about equities, which is not a bad place to start. You can start with, let's say, for example, U.S. stocks. You can start with international stocks as well. You can think about value stocks, right? Value stocks are different than what you're seeing in today's society. A lot of people are investing in growth stocks. So think about Tesla, think about Amazon, think about these stocks that you think are going to be through the roof. You're buying them when they're really, really immature companies and you want to see them really grow to be something big. That's different than value stocks. Value stocks are usually as well-established stocks. They're not really having huge growth potential, but they give you solid dividends. They give you good growth, right? They're kind of like the boring stocks, but they, do produce some good returns over time. Think about your Home Depots. Think about your Coca-Colas, right? Think about your stable, for example, U.S. companies, oil or something like that, right? So those are the type of value stocks that you want to consider. If you are someone who is not really into risk or someone who's close to retirement, you can look into bonds. You can go into bonds, for example, corporate bonds, right? Where you're buying the bond from the actual company. You can go into bonds that are treasury, inflation protected securities. You can go into different types of things. I think if you go on to Fidelity or Merrill Lynch or any of these big brokerages, they have a ton of research that can help you buy bonds. But the whole point of it is that you're going to have a rate of return on your money that's going to be higher than inflation. Now, the last one I'm going to mention to you guys is gold. Gold has been the one that everybody mentions during times of inflation. Mark my words, once inflation starts to really peak, you're going to see everybody take their money and go into gold. They're going to buy the gold ETFs. I promise you, it happens all the time. The reason why is because, gold is something to keep ahead of inflation. It just has been that way. So you can have a part of that as part of your securities. Now, the one thing about gold is that you don't want to necessarily hold it for too long. The reason why is because during a periods of regular inflation, or even low inflation, which has been over the last 10 years, gold really hasn't done that much, right? So there's not a severe price movement in gold unless there's something big that happens. Usually it's big downturns or inflation. So those are the three things I think you should consider: equity, bonds, and I think you should have some exposure to, some sort of gold if you think that, inflation pressures are coming. Also, real estate does well during inflationary periods. So think about regular houses, right? Regular real estate, and also REITs, which are basically mutual funds that hold all these, different real estate or properties and whatever that produces income for you, right? So think about those things. Try to see if you can add them to your portfolio. I think you'd be pretty good. You want to be proactive about inflation, specifically because you want to make sure your money's keeping ahead of inflation, right? Your purchasing power doesn't decrease substantially over time. Now, all these asset classes I just mentioned sound really good, but here are also some other facts. The fact is that stocks and bonds usually do less well during times of inflationary periods because people start taking their money out the market, right? During those periods where there's high inflation, what's going to happen is the Federal Reserve has to raise interest rates. They have to pull the money out the system. When your interest rates increase, so do your bank rates increase. So people take their money out the market and they throw it into their savings account because they're starting to earn higher interest, for example. The other thing to consider too is that both stocks and bonds have higher correlation during times of inflationary periods, specifically because everybody is selling at the same time. So you're not going to get the proper diversification. This is another reason why a lot of people invest in gold during inflationary periods, because it provides the diversification. Also, it protects against inflation. So that's why you want to be proactive about inflation. You want to be proactive about making sure you stay ahead of your portfolio. Now, I'm not the type of person to sit there and trade all day long, but I do think you need to be conscious of macroeconomic things that can occur that can, significantly influence your portfolio. So that's what I would do. Number one, make sure that you have your inflationary securities ready to go if and when you feel like you need to do it. Number two, make sure you're reading about what the Federal Reserve is going to do in terms of increasing and decreasing interest rates. But stay the long course, right? Inflation comes and goes, but at the end of the day, keeping your money working harder for you than it is for inflation allows you to really produce financial wealth. I'm Debt-Free Joel. Thank you for watching. If you have any questions at all, feel free to put any comments below. Feel free to like the video. Feel free to follow me on Instagram. It's the same handle as YouTube, @DebtFreeJoel. And I'll see you next time.